All right, let's talk about a huge change from the recent budget that's shaking up how stock buybacks are taxed in India. Now, if you're an investor, this is something you're definitely going to want to pay attention to because it could mean a lot more money in your pocket. So let's break down exactly what's changed and, more importantly, what it means for you.
Okay, so let's get right to the heart of it. The big question everyone's asking is, did the government just hand us a major tax cut on stock buybacks? Well, let's dive in and find out. The short answer? For most of us retail investors, it's a resounding yes. You see, the finance minister just announced a really fundamental shift. From now on, any money you make from a share buyback won't be treated as dividend income anymore. Instead, it's going to be taxed as a capital gain. And trust me, that one little change, it makes all the difference.
Okay, but before we really dig into the nitty-gritty of the taxes, let's just do a super quick refresh to make sure we're all on the same page. What is a share buyback anyway?
Well, simply put, it's when a company decides to buy back its own shares from people like you and me. They can do this from the open market or directly. It's a pretty common way for a company to return some of its cash back to its shareholders, and when they do this, the total number of shares out there in the market goes down.
All right, so to really appreciate why this new rule is such a game changer, we need to rewind a little bit. Let's look at how things used to work under the old system that's been in place since 2024.
And here's the key thing about the old rules. Any profit you made from a buyback was treated as if it were dividend income. What does that mean? It meant that money got lumped right in with your salary and other income, and you were taxed on it at your personal income tax slab rate. Plus, companies would deduct that tax right at the source before you even saw the money.
Yeah, just let that sink in. If you were in the highest income tax bracket, you were looking at a whopping 30% tax hit. A huge chunk of your profit just gone. You can see why that made buybacks feel a lot less appealing for a lot of investors.
Okay, so that's the before picture. Now, let's jump to the after. The new system from Budget 2026. This is where everything gets turned on its head.
And this comparison says it all, doesn't it? We're moving away from that painful slabbed rate that could go all the way up to 30%. Now it's a simple, fixed capital gains rate. It's treated just like any other gain you'd make on an investment. If you held the shares for a short time, it's 20%. But, and this is the big one, if you held them long term, it's just 12.5%. That's a massive drop.
So you gotta ask, right? Why the sudden change? What was the government thinking here? Well, the motivation is actually pretty interesting.
It really all comes down to one thing: curbing what's known as tax arbitrage. It's a fancy term, but basically, there was a loophole that company promoters, the insiders, were using to pay less tax than regular shareholders. The main goal here was to close that loophole and make sure the system is fair for everyone.
And you can see that strategy playing out right here. It's actually pretty clever. While folks like us, individual investors, get that sweet 12.5% long-term rate, the government has created different, higher rates specifically for promoters. Corporate promoters get taxed at 22%, and non-corporate promoters are at 30%. This way, they level the playing field without penalizing the retail investor. Pretty smart.
Okay, enough about the big picture and the why. Let's talk about the bottom line. What does all of this actually mean for you, the individual investor?
Just remember where we came from. Under the old system, if you were in that top bracket, this was your reality: a 30% tax on your gains. Ouch!
And now, for shares you've held long-term, that tax rate absolutely plummets all the way down to just 12.5%. We're talking about a massive difference in how much money you actually get to keep.
Oh, and it gets even better. There's another little bonus tucked in here. The first 1,25,000 rupees of your long-term capital gains are completely tax-free. That's a huge plus, especially for smaller investors.
So let's wrap our heads around this. The key takeaways are pretty clear. First, you're looking at some serious potential tax savings. Second, it just makes the whole system simpler and more logical. Now, the tax on a buyback is the same as the tax on selling shares in the open market, which just makes sense, right? And for companies, this makes buybacks a much more attractive, tax-efficient way to reward you, their shareholder.
And all of this leaves us with one big, forward-looking question. With this new, much friendlier tax structure in place, are we about to see a wave of Indian companies using buybacks to reward their shareholders? It really makes you wonder. This one policy change could really reshape how companies return value to investors for years to come. Only time will tell.